Hello everyone, welcome back to my channel. So Capitaland China Trust or CLCT just released the first half 22 numbers and I have just one concern, but it is a very big one though, and that is China. What is happening to China? So we have, if you just Google China lockdown 2022, you find that China is starting to lock down again. So first of all, Shanghai was really affected, and they have locked down Shanghai for a very long time actually, a few long weeks. Then Beijing was affected, and that was really a big concern for me because this REIT has quite a lot of properties in Beijing. Of course, now it spread to Harbin, Heilongjiang, and recently seems to be affecting Shenzhen as well. And I don't know if Guangzhou will come next, but you can see that in 2022, China is going back to a lockdown again, and this is really bad for retail malls, and especially here lockdowns and the rental reliefs. Subsequently, you also see something in China, which is the mortgage crisis. So what started last year with the three red lines on property developers. So the government wanted the property developers to deleverage, to reduce their loans, and a series of tightening measures was enforced. And you can see that ever since then, the Chinese property developers started to get a lot of difficulties with getting loans and therefore developing their own properties. And now that the development is kind of halted, the mortgage buyers, the buyers are starting to boycott on the mortgage, and that's gonna have effect on the banks, right? Because now the lenders are not getting the payment back, and it seems that the central government is stepping in right now to defuse the situation. But of course, CLCT is not a developer in any way. But nonetheless, I guess this stuff will probably have an effect on the credit spreads in China, right? The confidence of the lenders to lend money to other sectors. The good thing is that the CLCT takes a lot of offshore loan and it's just like 18% onshore. But nonetheless, I think this low credit crisis is really another thing that investors have to keep in mind. Of course, finally, it's really funny because for the rest of the world, talking about the rising interest rates, you can see that in China, the PBOC is lowering rates. So the 5-year LPR is lowered to 4.45. So in China, we have a case of rates coming lower, which is a stark contrast to the rest of the world, right? You look at the Federal Reserve, the ECB, RBA, BOE and stuff. So it's really a divergence between the rest of the world versus China. For the rest of the world, we're talking about inflation, and I'm sure everybody can experience it, um, and rate hikes. Whereas for China, we're talking about lockdowns, credit spreads widening, but a rate cut. So you can see it's really different, right? The dynamics are completely different. It's as if we're talking about one planet over here and another planet over here. So it's really strange. And the investment glasses that you have to put on while analyzing this REIT is so very different from the rest of the REITs. I find it really interesting. But nonetheless, for the entire globe, regardless of the rest of the world or China, one common factor is a slowdown, I think, or even a recession. Because for both regions, we are really talking about an economic slowing down. For the rest of the world, it seems to be a bit of a self-imposed recession caused by the central banks tightening. Whereas for China, it's a policy tightening, right, of the lockdowns, deliberately trying to suppress economic activities to beat the virus. So it's a zero COVID strategy, right? So I find it really interesting. So coming into the results announcement, I had really bad expectations, very low expectations, especially in the month that Beijing was announced to be affected by the COVID and some areas put under lockdown. I thought, oh man, it's gonna affect this REIT quite a fair bit. But the results actually beat my expectations actually. Perhaps given that I had pretty low expectations to start with. So the revenues and NPIs are up, but that is to be expected, right? Because they actually bought there's 4 logistics properties last year, funded by a equity raising exercise. But you can see that overall on the all the way to the bottom line of the DPU, you can see that actually the DPU is higher actually. So this acquisition was actually accretive, very accretive actually. So overall DPU was up, but unfortunately because of the lockdowns, they have to retain capital. So the eventual DPU release is lower. So unfortunately, again, this is a demonstration of the two different worlds that we live in, right? For the rest of the S-REIT space, we are seeing the REITs releasing the capital that they retained for the past 2 years, whereas for this one, they are retaining the capital ahead of the uncertainties. So it's really a big divergence. The good thing is that for the new economy properties of the business parks and logistics parks, they are reporting a positive 6% rental reversions. So that's a pretty nice bright spot, I think. In terms of the balance sheets and the concerns about rate rising, well, although this guy is onshore properties, but the fact that around 70% of the loans are offshore in Sing means that a rise in Sing rates will affect the interest payments for this guy as well. So rising interest rates does have an effect on the REIT, although there's a 18% onshore. But the problem is that the onshore rate in the renminbi is still higher than the offshore loans rate in Sing, right? So it still makes sense for them in terms of funding costs to take more loans in offshore. Although with the rising conditions overseas versus the loosening conditions onshore, I think these two credit spreads might be tightening. So it might come a stage where it makes sense to take more onshore loans if conditions permit. But you can see that although gearing is kind of stable, you can see the credit cost of debt creeping up a little bit by 7 basis points in 3 months. So as a refi, I guess the loans are priced higher. They've increased the hedge ratio for the income as well to 77% in view of the volatility in the FX. So if you look at the funding sources, well, they've refied everything in 2022, so that's good news. But you see this block over here, which is pretty high in 2023. So I suppose if the rates continue to edge higher, which I think most people are expecting, when they refi this block, the cost of debt will probably be higher. So there's probably gonna be an effect on 20% of the debt by next year if the Fed continues to hike aggressively. But of course, the path of the central banks is unknown, right? Are they gonna continue to hike all the way for the next few years, or are they gonna hike and then keep it there, or hike and cut? Because now the people are saying that there might be a recession, and after they hike it to combat inflation, they might be forced to cut. I don't know, man. So this is really interesting, right? Because for the rest of the REITs, you look at the other metrics like the NPI, DPU, the rental growth, etc. For me, right, this is a slide that I'm most concerned about, which is where the properties are located. So you can see that quite a fair chunk is in Beijing, 39%, and 15% in Guangzhou. So the Yangtze area in so Shanghai, Zhejiang, Jiangsu and stuff, right? 15%, and the other stuff is 32%. So which is why I was really concerned in so earlier part of this year when Beijing was affected by the COVID spread and some areas spread down, because you have close to 40% in Beijing, right? So for this REIT, where the properties are located is actually very important, because once that area flares out with COVID and the authorities put it in lockdown, man, it's gonna be really problematic. So the good thing is that everything's open right now, but there are two areas affected, right? Retail, which everybody knows, right? Once you have COVID, the malls have to close. And then surprisingly, the logistics parks are also affected for around 2 months at Shanghai because of the flare-up in Shanghai. So logistics parks in China are also not immune to the lockdowns. Business parks are kind of okay though. So for the retail, you can see that actually it's kind of okay. Occupancy is still kind of stable. Only concern though is that once they're affected by flare-ups, rental we have to be waived, right, for some of these affected tenants. So occupancy might be constant, but the amount of rental assistance will have to vary. And for this period, the rental reversion was minus 3%. Well, I guess it's expected, right? What do you expect? So business parks are established, over here, and logistics parks are kind of established as well. Good thing is that they have rental escalations embedded in the lease. And for the business parks and logistics parks, as mentioned earlier, they actually demonstrated a positive rental reversion for the period. So that's a bright spot, right? So this is the final slide, which is of course the problem in China. But I think that a lot of it is actually priced into the share price. So you can see that the when the stuff started spreading in March 2020 in Wuhan, right? This stuff really created, right, to 1.04 or even below. I don't know, something like that, around $1. And right now, if you look at the share price, it's 118, 116, and one stage I think it went below 110 or something. So the market is really pricing a lot of gloom, right, for the situation. I kind of agree in that well, it's looking like this zero COVID strategy is here to stay. I'm not sure for how long though. So I think the mood is a bit gloomy. Um, but nonetheless, right? When there's a uh, opportunity, when there's a danger, you might find opportunity. Because in the slides, actually first few pages of the presentation slides, they tell you that the distribution yield is around 7%, right? Which is pretty high, right? Based on the share price of 116 and the DPU of 8 cents. Um, so here's the golden question, right? Is a 7% yield, around 7% yield, enough to compensate you for the risk of this zero COVID strategy in China? So that's a golden question, I guess, for everybody who's interested. So that's something you can think about. So we've come to the end of this video. If you like what you saw, remember to subscribe, like, share, and comment. So if you like to waste a few more minutes of your life watching another video, remember to watch the next video and see you soon.